Welcome back to another episode of FPONG, Financial Planning for Oil and Gas Professionals. This week on the podcast, we are visiting with Scott Darling on the idea of retire in five and all things retirement planning. Scott, thank you for joining us on the podcast.
Yeah, thanks, Jared. I've been looking forward to this.
Yeah, we're really excited to have you. I know you've recently retired, so this is all kind of fresh on your mind. So you're a career super major employee, right? You worked at ExxonMobil for over 34 years. Your last role, you've had a bunch of roles, but your ultimate role was serving as a CFO of ExxonMobil's low carbon solutions. I thought a good place to start this conversation to kind of intro you. I definitely want you to talk about your career, but you had this awesome post on LinkedIn that I just want to share. I'm just going to read through it as kind of like an introduction of you. And you posted, it was numerical reflections on my career from the vantage point of my last day. You worked for one company, you worked in 3 cities, 4 different businesses, 8 locations, 18 jobs, 22 supervisors, almost 35 years, 63 countries, 417 paychecks, 805 vacation days, 7,995 work days, 84,000 hours, not including hours worked at home, 403,000 miles commuted, lots of friends made, countless memories, no regrets. Man, that is such like an awesome way to just kind of summarize it. I guess my 2 questions are like related to that. How long did it take you to aggregate all that information? And had you been keeping it along the way, knowing that post was coming someday? And then are you at all surprised with how much you did and that your whole career was spent with one employer?
Yeah, no, I did not expect to work for one employer. But that came. I retired last year on April Fool's Day, on April 1st. I thought it was a fitting day to retire. And that post came as I was trying to reflect on what I wanted to say to people. And there's this tradition in ExxonMobil where people write the proverbial email out to their entire email list and say, this is, reflections on my career. And everyone knows me as a numbers guy. So I started thinking about numbers and I thought, well, what can I say about, quantifying in some way the career that I had, starting with, like you said, one career, one company. And so that actually came to me at 2 a.m. as I was on my very last day, and I was just thinking through it. And I got up out of bed and I tallied all those numbers together and posted that on LinkedIn that night. So no, I did not. I did not keep track of it as I went, other than a few things like the number of jobs I had and the number of supervisors I had and stuff like that. But when you think about a career, one of the things I've said to a lot of people is I think very few people actually end up doing what they study in college. And I was no exception to that. I studied petroleum engineering, from the Colorado School of Mines because I was interested in STEM. And I also thought it would be a great place to make some money because petroleum engineering paid a lot when I got out of undergrad. But the reality is my career took none of the path that I thought it would take in the course of working, including the idea that, even my dad didn't work for only one company. And, from his generation, that was kind of the thing to do. So,
Yeah, and I think like it's interesting because like as you gave a numerical reflect, like when you say somebody works for one company, it seems like you're doing one thing. But the interesting thing about like ExxonMobil, and I'd love for you to like talk about maybe some of the stops along the way, is it probably felt like new companies, right? Like as you worked in different divisions and segments of the business, and because of like the size and scope and the diversity of revenue base of a company like ExxonMobil, like it probably didn't feel as monotonous as I worked on the assembly line or I worked in this really tiny office doing the same task for decades.
yeah, yeah, for sure. And that's really one of the selling points. One of the things that kept me at ExxonMobil for 35 years was that I worked for a lot of different groups, a lot of different people, with a lot of different people. And frankly, in a number of different companies, ExxonMobil is a large entity and it's got a lot of different kinds of businesses, all related to oil and gas. But I started out in the downstream, always in a financial capacity, but I worked in supply and trading. I worked in our corporate environment. I worked in our chemical company. I worked for our upstream company 20 years after I got a petroleum engineering degree. So you didn't want me drilling any wells at the time, but nevertheless, I worked in upstream. And then when we formed our low carbon solutions group about 4 or 5 years ago, I had that right mix of commercial and finance experience that they were looking for someone to start up a new company effectively within ExxonMobil. And for a while, my claim to fame was that I was the only individual out of the 68,000 people in ExxonMobil that had actually worked in all four businesses that we had, because Low Carbon Solutions at the time only had 5 people. And now we've grown to, 400 people, and the business keeps growing. But the beauty of a finance career in a company like ExxonMobil and that's capital intensive is that you got to mix the engineering with finance, and all the business decisions that go with that. And it gives you the opportunity to work in those different business environments and different opportunities, and frankly, if you want to, in different countries and cultures as well, all within the umbrella of the sweat equity, if you will, that you build within one company.
Yeah, that's the interesting thing is like younger generations are much more mobile. Like the idea of being a career person for decades is kind of it feels like a relic of the past, right? And so like as that changes, how do we, like, yeah, you could jump and get an increase in responsibility or pay or compensation, but your relational equity, you're building off of a base of zero. So like there's, that's like a phantom cost. It's not easily observed, but I definitely think it matters.
Yeah. And the reality is, I looked at different points in my career at outside opportunities, testing the market, seeing what was possible. And even, folks on my staff, I told them, I love you to work for ExxonMobil, but in your 5th year, in your 10th year, in your 20th year, you should be looking to see if this is what you still want, and, convince yourself that the company that you're working for is the company that you want to continue to work for, and that it's doing right for you, and that it's got the right kinds of opportunities that you're looking for, and that your market, isn't better elsewhere. And I tested that. But the reality is, ExxonMobil kept throwing opportunities at me. And I had 18 jobs within a 35-year career, which meant I was moving jobs every couple of years. And that's exciting. It kept things fresh. But like I said, I continued to work with people. Our paths crossed over the years, again and again, and so it's a great comfort to not have to reinvent yourself socially within your work environment all the time as well.
Absolutely. So I want to talk a little more about, your kind of experience. You exist at this intersection of like petroleum engineering, kind of oil and gas, and finance, right? Like you eventually you got an MBA in finance from UT, finance, a bunch of different finance related roles within your tenure. And we'll talk about the retire in 5 Yammer,
Mhm.
and just kind of personal finance stuff. I'm curious, like, did that interest, did that predate or postdate petroleum engineering? And or did you kind of always have that? And what led you to ignore that if you did have the finance passion?
Yeah, sometimes I wish I hadn't ignored it, because I think I might have been, I went into finance, but I actually think I might have enjoyed a career like what you're doing in financial planning as well, because I really like that. We'll talk about it later, but um, and I can remember when I was 5 years old telling my parents I wanted to be a banker. I didn't want to be a fireman or a policeman or whatever. I liked counting money. I thought it was fun, and I liked keeping track of things. And it was my early planning days, and that so I always kind of had a intuitive feel for finance, and what I learned was finance over time. But when I was in high school, and you really don't know what you want to do in high school. When I was in high school, I was good at math. I was interested in the sciences. My dad was a geologist, so I grew up in the oil and gas industry, if you will. And so engineering made sense, and petroleum engineering made even more sense to me at the time. Now, I graduated in 1987, which was the worst year to graduate other than 1986 with a petroleum engineering degree, I think, in history, because of the industry was so depressed at the time. And during my time at the Colorado School of Mines, I kind of figured out that there were things that I was more interested in than just strictly engineering, and that typical technical path. I took a class from Frank Sturmel at the time. It was financial decision making in an engineering career, and it was all my introduction to NPV and things like that. And I was much better at that than I was at engineering. And so I got an MBA straight through. I wouldn't advise that to anyone. I don't even think you can do it anymore. But I got an MBA straight through from the University of Texas, and with the intent of working in the oil and gas industry, but on the finance side. And I went to work for Mobil, and then as I said, I transitioned through all those different businesses that Mobil had, and then when ExxonMobil merged, I had a bigger envelope to work with. So, but my interest in finance goes kind of way back, and the energy industry is a great place for that because it's capital intense, which means you got to spend a lot of money, which means you got to find a lot of money, and so a big portion of my career was focused on structured financing, doing really big financings like multi-billion, tens of billions of dollars of debt that we raised on behalf of our partners and us to finance really big projects around the world. And that took me around the world, and that was a fascinating place to be. So, like that intersection you said of oil and gas and finance comes right there because it's all a collaborative effort between engineers, business people, ESG, all those kinds of things, along with finance.
Yeah, it really is like, having that like holistic experience is, I just think so valuable, right? Because you learn so much. And like, for me, for example, like I studied finance and it kind of sounds similar to why I did petroleum engineering, not because I necessarily woke up really excited about finance, but it seemed to leave more doors open. Because I think even at even in college age, I knew that if I wanted to, let's say, do marketing, it'd be easier to go from finance to marketing than it would to be from marketing to finance, right? So just having like a baseline amount of like numerical competence, I think is just, something that'll serve you. Like getting a more technical degree, even if you end up doing softer skills stuff, I think is a really good way to go. I've always been kind of really blown away by oil and gas capex. It's so fascinating because like it's so high, like and like the financial engineering involved to execute these big projects is so big, but also like the delayed gratification is so substantial, right? Like if you're going to build a new plant or a new pipeline, like the infrastructure to do that, and like when the cost is deployed to when you receive any economic benefit from that, the economic environments can be drastically different. So it's just really interesting, like thinking through all of the different iterations. And I'm sure there was just a really robust modeling process. But even with that, because of how delayed the payoff is, it's really kind of your best guess at what you think the future is going to be like, and hopefully having a margin of safety where your break even rates are pretty compelling.
Yeah, it means that your principles have to be really strong, especially your financial principles. But everything that you do, the way that you invest, and I think this is one of the strengths of ExxonMobil is we didn't necessarily blaze any new paths, but we were really good at optimizing the path that we were on, and frankly, really good, except for a few notable exceptions, at not avoiding the bad mistakes that so many companies in our industry make, and that's what causes that cyclicality. I think Exxon was really strong and continues to be really strong at investing through the cycle, and not investing so much on the basis of a projection, but on the basis of principles and how we want to operate.
Yeah, that makes a ton of sense. So one of the things about ExxonMobil is they had a Yammer, which from my understanding, I've never been on it. It seems like a Slack equivalent, like an internal kind of messaging platform. So on that platform, there's like a retire in 5 group, which is basically, my guess, just this place where people can go to ask questions. And in light of who I know you to be and who you've described yourself to be, you were an active participant in that group. I'd love to hear a little more about like that, what that being in that was like, and like how helpful that was to you, how you've might maybe have helped others in there, and kind of like who are the people in there and what are they talking about?
Yeah. So it was a Yammer group, which was, I think, a somewhat outdated technology that's now been replaced by Facebook group. So there's still a couple thousand people in the ExxonMobil Retire in 5 Facebook group, and then there's one for some unofficial groups in Facebook for various retiree groups around the country from the company. But what I'd say is, first of all, ExxonMobil does a pretty good job of helping people along in the retirement process or the financial planning process. They sponsor a set of trainings at early career, mid career, and late career that help you think about what you need to be thinking about and doing what you need to be doing. Doesn't replace being active in your own financial planning and having a financial advisor, but at least it helps people understand the specific benefits of ExxonMobil. But what these Facebook groups now do is it allows people to come in and ask really specific questions to people who have just done it. So the idea of Retire in 5 And if your company doesn't have it, I think talking to listeners, they should create one, because it's a valuable group of folks that um, can share information. And Retirement 5 is for people that are, in theory, within about 5 years of retirement, where you're starting to really think about the logistics of it and what does all that mean. And so the big questions are, specifically the logistics. And how do I get this done? It's not so obvious in a big company with, lots of policies and things that, what are the order that I need to do things in? Where are the hangups? What do I need to bring with me? All that kind of stuff. What do I need to know? We have a pension. Okay, it's a rarity, but oil and gas, they have pensions. ExxonMobil has a pension, and it's gigantic decisions that need to be made at the point of retirement about whether you're going to take just an annuity or a lump sum, as an example. So those kinds of, it gives people the opportunity to ask those questions, and it's amazing the perspectives that you get from people, and you realize that financial decisions are not just about the math, right? They're about behaviors, they're about choices, and it's all very, very personal. And then there's other things like NUAs and rollovers and Roth conversions and trusts and giving, and every topic that you can imagine. People ping and say, has anyone thought about this? And then people will chime in.
I love that too, because like it's a comparable peer group. Like I think if you just ask the general public, it's just like I would say oil and gas, like retirees have a very unique, homogenous set of circumstances, but unique relative to the rest of the population, right?
Right.
The match historically has just been remarkable. The contribution to defined benefit pension plan, your mix of pre-tax to Roth or after-tax assets is really, it's very skewed one way. And there's some opportunities and kind of some planning complexity that comes with that. But being able to talk to a peer group, I think is really helpful. It's wild because, as I think about the next generation, I think one of the interesting things about compensation is like the number of variables and decisions you have to make before retire in 5 has like increased, right? So like if you think about, if your two primary savings vehicles are 401k and a pension, the only decision you can really make is how much am I going to contribute to the 401k and when do I leave and what's the value of my pension,
Right.
But as businesses start to migrate towards lower pensions or less defined benefit and more equity compensation, there's so many more decisions intra-year. Do I hold it? When does it vest? What's the taxation of vesting? Is it an RSU? Is it a stock option? So it is kind of wild how, as I think executive compensation in general gets more complex, it's almost like you need a retire in 20 group because, with how many more moving pieces in terms of compensation. And it makes sense that companies are doing this to kind of get that liability, defined benefit plan is a huge liability that just sits on their balance sheet for a while. So I get the migration, but it has kind of made planning more interesting as you look at the people coming up now versus the number of variables, that might have existed 20 years ago.
Yeah, I get that, trying to just help I have 4 kids and trying to help my kids through, coach them through that whole process there between 22 and 32. And it's kind of like, what do we need to be paying attention to? And they grew up listening to me talk about finance at home. We were a pretty open family about where we sat and things like that and what I was thinking about. But when you're off on your own in your 30s and even 40s, it's how do you think through all those things? The knowledge base. What's interesting about a crowdsourcing for information group is there's a lot of knowledge out there. There's a lot of misinformation as well, and so you got to be careful about and expand that to the internet. You got to be careful about what you read and what you hear, and everything that you read and hear is not accurate, even from some so-called experts.
Yeah, intensity doesn't equate to competence. The loudest voice isn't necessarily the smartest one. And usually the inverse of that can be true. I would love for you to just, based on your kind of fly on the wall and just chiming in observation, what would you say? Are there any like common misconceptions or things where it was like, man, this piece of the, whether it's, hey, pension and the interest rates are really misunderstood, or like, hey, this benefit isn't even talked about, but should be. Are there any things like misconceptions or things you noticed as you were participating in that kind of caught your eye?
Well, certainly even not understanding what happens with an IRA, with a 401k, the concept of RMDs and what that means from a taxable position as you get older, and the effect that may have on your taxable income as you get older is an example of that. But the basic math of equating an annuity with a lump sum is really poorly misunderstood, and I'm not surprised. It's complex math when you work it all out. But the idea that the annuity, there's no embedded advantage between an annuity from a retirement plan and the pen and a lump sum pension. But everyone takes a view that, oh well, interest rates are high now, so it must be, the lump sum must be worse, or vice versa. So there's just that's an area where it does get tricky, and then you get into more complicated topics that not everyone participates in. For example, if you don't participate in executive comp in an oil and gas major, there's a whole side of that equity participation in stock, and what that means, and how that's going to affect your financial planning even after you retire. Because those RSUs, or those options, they don't vest in the same way that your salary does, obviously. So things like that. Unless you've thought about it a lot and kind of modeled it out, I can understand where people really don't have a great handle on how that all fits together.
Yeah. And the other crazy thing is like how it all fits in concert with everything else, right? Like it's interesting because you could do the math to figure out the complex math of figuring out, hey, pension versus lump sum on a net present value basis. But if I take the annuity, it's created less income flexibility in my plan, which could potentially be a liability, right? Like as we think about optimizing lifetime tax rate, having volatility in income can actually be an asset because it creates planning opportunities. But if you have a
Right.
baseline amount of income that's, you have a tax floor essentially because that income is there. So, it's like it's hard in and of itself. But then if you actually take a step back and think about all the other things it touches, it adds a whole nother layer of complexity.
Yeah. Yeah.
So question for you, as you were looking at these people who might have been prepared, unprepared, how did you think about like retirement preparedness? Was there like a number where it's like, hey, I think I'm prepared, or hey, I've been in retire in 5 for 3 years, so I think I have all the tools in my belt. What led you to kind of decide? Was it a number? Was it a feeling? Was it hey, I've satisfied these 4 things at work? And then kind of like tangentially to that, maybe this is kind of connected to your definition of success. So I'd love for you to talk about coming to make that decision, how you viewed success in that, and kind of define that as you were thinking through all this in your own life.
So how did I know that I was ready to retire? That was like the easiest decision I've ever had. It was kind of funny. It was obvious when it came about, but it didn't come without a lot of forethought. First of all, I had been a financial planner all my life, from a personal perspective, and we can talk more about that. You're aware of some of the things that I've taken to the extreme when it comes to financial planning, but I always had in my head that there were 2 numbers out there. I had a dollar number in my head that seemed about right, and it was kind of like a proxy for the lifestyle I wanted to have in retirement. And that moved as things changed in my life. It got higher as I made more money and my career was more successful. And I thought, okay, well, maybe my number's higher than it was. But the reality was, I had an age that I didn't like. Work wasn't my passion. There were other things in life that I liked doing besides work. I enjoyed my job. I enjoyed my career. I loved my career. But I don't miss it. And I didn't want to ever work past 60. And at ExxonMobil, you can retire at 55. And in my 40s, I was convinced that my number was 55, that I was going to go as soon as I could take the pension that was available to me at the time, and I was going to do something different. I was going to change careers. I haven't woken up. I'm not working, and I haven't woken up a day since I retired and said, gee, I wish I was back working again. I've got plenty of things I want to do. So it turns out that that wasn't the plan. And as things, as I got new opportunities at work, that age also crept around. But I guess what I'm trying to say is that, people can put numbers out there, whether it be age or dollar figures. And my advice to them would be, yeah, have a general idea what that might look like, but, take life flexibly and figure out as things change, be adjustable. You asked, what does it take to be successful? I have maybe a different answer than a lot of people would probably have for that. And maybe it comes, if you'd asked me what does it take to be successful when I was in my 20s and 30s and even 40s, I would have said, it's all about talent, and it's a little bit about, how hard you work. And I'll call that discipline. Looking back on it now, I think about all the things that fell my way and all the things that did not fall my way, but didn't matter. I almost think that 50% of where you get to in your career is due to luck. Good luck at the right time and avoiding bad luck at the right time as well. Being in the right place at the right time, meeting the right people, having the right person speak, the right things about you in the right meeting. You can do the right things to put yourself in the right positions, but there's a lot of luck involved, and we shouldn't dismiss that. And then after that, it's kind of like equal parts of talent. What knowledge do I have? What experience do I have? What's my intellectual curiosity? Behaviors are I think as you get older, as I got older, I noticed that behaviors were more and more important. So finding that kind of right balance between collaborating with people and working with people, and also being a little bit stubborn about holding the line when you thought you were right. And then discipline, it's just sticking with it. It takes time. And a lot of things I think I just named off are applicable, moving to retirement to how you invest as well. If you retire at the wrong time, if you don't happen to, you're right, your earning years aren't on when the markets are doing well, there's a lot of things that you just don't control that I'll chalk up to luck. And then after that, it's, what talent can you provide? What behavior do you have, and how long can you last? So I'm not 100% sure I answered your question, but
no, it's good. There's a few things I want to touch on there where I love that. Like, so Carl Richards, he's right for a column for the New York Times, and he's like, he draws these sketches about financial concepts. One of his ideas that I love is called luck surface area. And it's essentially what you talked about. Hey, luck is going to play a disproportional impact in my career, but there are things I can do to increase luck surface area, whether it's being ethical, whether it's going above and beyond for the people that need it, or, just using your relationship, like using your lunches to network and build relationships with your peers, right? Like, so like, I love the admission of, hey, luck was a part of it, but also like, it sounds like there were things you did to make the surface area of luck hopefully a little bit better, right?
yeah.
So, it doesn't necessarily mean that someone with a tiny surface area isn't going to get lucky. It's just you're just helping with probabilities. So,
Right.
I love that you kind of talked about that. I think the other thing that I loved, it was just such a like just an admission of, you liked your job. Is it like your burning passion in life? Like, I think, like, especially like I have a lot of peers, and I see like some of our younger clients, like there's like maybe a burden of like, is this exactly what I'm supposed to be doing? And sometimes, I would say if the work is stimulating, if it creates the balance in your life where you can do the things you want to do and you're fairly compensated for it, that's a great job. I think, we kind of have this paradox of choice where if anything is available to you, it's like, am I doing the right thing? For most of human history, there were two jobs in the town you grew up in, hunter or gatherer. And, it's kind of like that. I didn't have the space for this existential crisis of, am I doing the right thing? So I loved your kind of admission there. And it wasn't that, hey, I don't dislike my work, but is it the thing you dreamed of doing? I don't know, probably not, but it was rewarding enough relationally, financially, intellectually, where it's like, hey, this is a great thing to do. So you definitely answered my questions, but those are the two nuggets as I was just listening that I thought, man, those are good. And our listeners can learn something from that.
Well, Jared, you bring up something else, and I was talking with a friend of mine. We get together. He actually, who was my boss for 10 years. We get together and talk every once in a while. And he's got a son that is super smart, and he's way into math, and he's also really into fixing up old Stratocaster guitars, and that's his passion. And I was saying to this friend of mine that I'm reading the Scott Galloway's Algebra of Wealth right now, and Scott has this concept that says, everyone wants to work in their passion. And they say they start out, find my passion, then go find a job. And he goes, that rarely works. A lot of passions don't pay. Instead, figure out what you're good at and go do that. And over time, that talent will become your passion, which is a cool way of doing it or thinking about it in my mind, because I didn't wake up going, gee, I want to be, a finance guy in the oil and gas industry. That's my passion. But it had a lot of ingredients that I liked. And over time, I thought it was it was a great place to spend 35 years. So obviously I liked it. But by the same token, I also read a lot of literature around retirement said you got to find your purpose. And it's almost maniacal that people they get a lot of anxiety that I can't retire until I have a purpose. And I would tell people that that may be true for some people that are really ingrained into what they do, and maybe they shouldn't retire. But for me at least, I didn't need a purpose in retirement to supplant what I was doing in my job. I found plenty of things to do that are, smaller in nature than a career, but they're very fulfilling, and I have no problem spending my day, doing those kinds of things, and we can talk about it if you want. But
That's a great place to go next. Cause like I think one of the things I've talked about this before, but like I think hard stop retirement's tough for everybody, really demanding job and then going to doing nothing. Right. Like it is kind of weird how abrupt that all is. And I find a lot of people
sure,
work, and I'll say work generally, whether it's like increased volunteering, whether it's some consulting on the side, whether it's being more active in the lives of your kids and traveling and, being grandparent duty, right? Like, there's some void that's filled there with work. So I'd love for you to say like, hey, in this season, like how do you stay sharp? How do you measure success? How do you kind of like define your ideal, like what's your ideal day kind of look like, and how are you using your time in this season?
I do have a set of goals. I was never a big believer in writing down goals until very late in my career. And I especially hated it when my boss came to me and said, I got to write down your goals and I'm going to hold you accountable for them. And here I am in retirement. I wrote down, 10 goals for 2025. I won't go through them all, but they're not earth changing. But it's like I want to read one nonfiction book a month. And when I was working, the last thing I wanted to do was come home after a long day. We'd make dinner, we'd do things. I'm a triathlete. I'd get on a bike and ride for an hour and a half on the trainer. Last thing I want to do at that point was sit down and read a book. But now I have time to do that. I want to take a painting class. I want to cook one new meal a week. Those kinds of things. I work at the food bank on Tuesdays. I'm on their finance committee. They're just those different kinds of things. Saturday, I'm running the Woodlands Marathon. I want to try and qualify for the Boston Marathon this year. So little goals like that all kind of adds up to when you think about what am I going to do today? Well, today I'm going to work on my physical training, or today I'm going to sit down and on purpose read a book for an hour or two. I just like having that time to do that in the core of the day. I used to get up at 5 a.m. and swim 3 times a week, and then I would, like I said, I'd get home and I'd go up on the bike at night to ride, because and I'd run in the dark. It was the only time I could do the physical activities I wanted to because of my job. Now I get to do all that stuff in the daytime. I go through swimming 3 times a week at lunchtime. It's great. So
Yeah. I love your answer too, because I think like a lot of people think, what are you going to do in retirement? It's got to be this big, like one sentence thing that's consuming 40 hours a week. Like, no, like you made it much more manageable. What are the 6 to 10 rhythms that
yeah,
didn't get to nurture in my work time that I would like to build and grow upon in this
right.
season where I have more time to do that?
And
I think people get stuck.
I've had to get more comfortable being by myself too. Having been in a work environment, especially, a dynamic one like we had at Exxon. I spend a lot more time by myself, but I don't mind that because I also have times at different points every day during the week, I get together with, the folks I swim with or the people I work at the food bank with or that sort of thing. So, it's a mix of both.
Awesome. Yeah. And it's interesting because, you talked about this when you were a little while ago, but really there's, when you think about retirement readiness, there's two components. There's like numerical, and then I would say like seasonally, right? Like, am I ready to take on this new season? And like, do I have
Right.
an idea of what I want that season to look like? And I would argue the financial one is actually easier to solve because it's a math equation,
Sure.
right? And you could, and of course, inputs are changing, expenses are changing. But the harder thing is, hey, what is this season going to look like? And I love that we started kind of in order of operations of like, hey, what are what does this season feel like from a, life lived perspective? But I'm also curious about the numbers. Like, you're very financial oriented. So I'm curious, like, and you're regimented. So how do you track like how do you assess performance and like where you're at from a retirement numerical perspective? Because my guess is you have a framework for that.
From a financial perspective.
Yeah.
Yeah, definitely. Like I said, when I was 5 years old, I wanted to be a banker. I've always been a planner and a tracker and a counter. You know, no offense to those that are, but thank God I wasn't an accountant. But nevertheless, I do like accounting. I like to track things. And people don't have to know me very long before they find out about the spreadsheet. I have this spreadsheet that I have kept since I started working. So for 35 years, I've maintained basically a spreadsheet that keeps track of everything that I want to know about my financial life. And I could create, a classic three statement financial model out of it if I wanted to. An income statement, a cash flow statement, a a balance sheet. I don't do it in that form, but all the ingredients are there. It's got my income, my sources, my taxes, my expenses, different categories. It's got all my investments, additions, and returns, and all that sort of thing. And I keep track of that by the different structures that we have financially, by the tax and estate treatment. I can do allocations, my target allocations, my actual allocations, my investment diversity. Why do I say all this? It's because I have the numbers built that allow me to do to track anything that you want to dream up when it comes to finances. And that's ended up giving me 35 years looking backwards of monthly data. So where does that get me? Every month I've got about 900 rows of data and information that I keep track of on a monthly basis, and I have that going back 35 years, and then I have that going forward 35 years as well, till my so-called death, which I have planned for when I'm 95 and my wife is 98. Just joking. And then I actually look 10 years past that, because what happens to our estate with my kids matters as well. So when, for example, when you make a decision like I'm going to make a Roth conversion, you don't see the effect of that unless you see what happens to estate taxes and things like that. So in my truly weird way, I went 35 years plus another 10 after death. Anyway, it's all dynamic, and the reason that it's built that way is because I can plan optimizations, I can do future casting, and I can look at key metrics. And I think that's what you asked about. So what kind of key metrics do I look at? I look at investment mix. I look at a funded ratio of years expense coverage and fixed income. I look at sort of a risk bucketing approach, to take the bucket approach of, three risk buckets: a more conservative, a less conservative, and then a risky bucket. I look at total net worth. And because we are in this planning phase of how do we think about, gifting money to our kids and going beyond my wife and I, I created this metric called the theoretical intergenerational wealth, which is how much money do we have we created for the family. And it sounds really geeky, and it is, but it's a way of someone like me keeping track of, how do we look as a family unit, and kind of planning as a family unit as opposed to just my wife and I. So financial planning is a hobby for me, obviously, and it's not for most people the way I do it, but it does allow me to, to keep track of things and to feel comfortable when it comes time to make big decisions like retirement or buying a second home or things like that we're in good shape to do those kinds of things.
Yeah, I think the call to action is not develop a spreadsheet as robust as Scott's. No. The call to add for our listeners should be get a framework that gets you key metrics so that you're solving for the right things and you feel comfort in making the big decisions and have a framework for doing that. Scott, I do want to talk about second homes, because that's something we get. Like, we had a whole podcast on that idea. And I think it's really interesting thinking about like financial break evens and also like ignoring that and thinking about lifestyle, but also it creates a more complex lifestyle because it's another property to manage. I'd love to just hear through, the decision and how you think about, or any advice you have for our listeners about like, when does a second home make sense? When does it not make sense? How did you come to decide that for yourself?
Yeah, and first of all, I'd say it's a personal decision. We bought our second home in Colorado, partly because we had a base in Colorado. I've got some kids that live there. I have extended family that live there. We bought a home in Colorado a couple of years ago, um, with the distinct idea and agreement between me and my wife that it was going to be a home that we use for flexibility to do what we want to with, as opposed to an investment. And I think that's an important thing for people to get to decide. I think it's really hard to have a vacation house or a second home if you truly want to use it that way. That's also you're trying to rent out and trying to make a return on. So I quickly came to the conclusion that what I valued out of and what I wanted out of a second place was the complete flexibility to go there whenever I wanted to, and to enjoy it and have my things there, and not have to worry about having a property manager or worrying about was I making a good return on this investment. I don't look at it that way. If you want to make an investment in real estate, obviously go for it. But I would advise people to separate those two in their heads if they're able to do that financially. I would also say that a lot of friends said, "Why are you doing that? You can Airbnb for a fraction of the cost that you're paying for that second home." And I said, "Yes, I could, but I would never do it. I would never, we're going up in a month for a month. I would just never get around to picking out another place and go in there. So that I really value at this point in my life, having that ultimate flexibility to do what I want and when I want. That's really important. In doing that, you have to be realistic about what it costs. The cost of our second home is as much as we spend on our primary house with a mortgage. So, and they don't all have to be that way, obviously, but you do have, and I know you guys had a piece on this in one of your podcasts recently. You got to look realistically and say, is this something I want to afford and something that I can afford?
Yeah. And also, too, how near and dear is the place to your heart? One of the things, like, I'm definitely not in a financial position to think through a second home yet, but like the other thing is, like, how do you travel? Like, what places are special enough for you for it to eat up a high percentage of your travel time, right? Like,
Right.
if I look at my 12 trips a year that I take as a family, two of them are to see family, and then four of them are probably to places never been, and then two of them are places I have been, right? So, like, if you pick a place, you're not going to have the energy or the time or the finances to really, maybe do the exploring to the extent that you would otherwise. So also thinking about, like, hey, what's your travel, appetite, and what does that look like? Spending less time in less time in more places, or, more time in fewer places.
Yeah, that's a good point, because when we bought it, we thought, oh, it's not going to change what we do, and the reality is, it does change what you do.
Hmm. Yeah. So two more things as we kind of wrap up. You talked about, thinking about terminal wealth, like wealth created for the family. And it led me to it reminded me about this thing you told me about. You have a rising equity glide path. So as time, you've decided that your allocation is going to get more aggressive. Said another way, 90-year-old Scott is going to own more stocks than you do today, which on the surface sounds crazy because over time, risk tolerance tends to go down as you get older. And like a lot of like target date funds and investment products, like they get more conservative over time in retirement. So like some people, it seems counterintuitive, but as you explained it to me before, it's not at all. But I would love for you to kind of talk with our audience about that, because on the surface, it's a different idea, I will say.
Yeah, 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 and it's not for everybody, but I can see where it would. It may apply to a lot of your listeners. And I'll say I didn't set out that way. It's not like I had some grand scheme that said I'm going to allocate this way when I'm young, and I'm going to allocate this way when I retire, and this way when I am retired. In fact, as I was young, I followed the conventional wisdom of allocation, and I started out with more equity. I don't know what it was, 90-10 when I was in my 20s, and given my situation, over time, I maintained a healthy equity to debt ratio. I probably should have maintained something higher, given the fact that I had a pension. It was one of the things I wish I had learned when I was when I was that age. But we had a debt-like pension. We had a stable job. We had we had no years in the 35 years that I worked that we had any drawdowns, and so you could afford a fairly high equity to debt ratio. Now, when I'm at retirement, I'm not particularly concerned because of our asset mix and our asset level. I'm not particularly concerned about the typical things that retirees are concerned about, like drawing an income. I feel like I've got enough cushion to be able to survive the volatility. What I'm more concerned about is sequence of return risk, where you happen to be drawing at the wrong time. Um, and so currently, that now that I'm in a place where I've just gone from having an income to not having an income, I'm very conservatively invested, 50 to 60 versus 50%, 60% equities. One of the things I learned as I was thinking about this, because it was right around the time I was thinking about retiring, my father passed away, and I started managing my mother's money. She's in her 90s. I know for sure, given her asset level, that she's not going to spend more than she has. And so it dawned on me that what I'm really investing for, and how I should be investing that money, is with the risk of my brothers and sisters, and I not for a 94-year-old woman, given that she's got what she needs. And so I started to think, well, how does that apply? How should I therefore allocate money in retirement if I feel like I'm in that sort of same situation where I'm not worried about the volatility of assets, I'm worried about the sequence of risk. And so what I do now is the way I've planned it is to allocate to fixed income the next 8 years of expenses net of income. And so I look at that and say, that's how much fixed income I should have. What that means is that gradually my investment risk increases, and I end up projecting around a 90-10 equity to debt ratio at death. Because as I age, I'm increasingly investing the estate for the benefit of my kids as opposed to meeting my own expenses. And that results in that what is a classic rising equity glide path smile, where you start out when you're young and you have a high equity debt ratio, and then at retirement it's at its lowest when uncertainty is highest, and then over time, as you become more certain, as you get closer to passing away, you can afford to invest more in equities over time. And there's been studies that show that that actually helps people in meeting their return objective better than a lot of other types of investing.
I mean, that's great, right? Like essentially, like it's really like it's simple, right? The net present value of your future cash flows go down. And
Right.
as your life expectancy decreases, the variable, it's like that liability that you're principally funding has, it's a smaller percentage of what this of your asset mix that's spoken for. So
Right.
it's
Right.
really just duration matching. Who is the ultimate person who's going to have control in spending this dollar and needs to spend it, and what is their time horizon? And in your
That's well said.
case, it's hey, as I hit my 90s, I want to kind of do that. And the need of the portfolio for me personally, the range of outcomes is tighter because the odds of you living to 130, much lower, right? You might have 10 to 20 good years depending on medicine. But so yeah, I think that makes a ton of sense.
What I might build on that, Jared, is that also, you would expect the returns on your assets to outstrip inflation. So if your expenses are going up by inflation, your assets are going up by some return, some real positive return, then you would expect your asset base to be growing. And so you can afford to take more risk with that asset base to fund the same set of expenses. If that doesn't work, and markets go down, then that funded ratio that I have actually forces me, rather than some arbitrary equity to debt mix, it forces me to say, I have some logic for what the fixed income portion of my portfolio should look like. And in fact, if that happens, you end up dollar cost averaging into equities at a lower rate if the markets go down. So like I said, it's not for everybody. There's a certain type of behavior and temperament and asset level that I think all has to come into play for that to work for people, but it works for a subset of people.
Yeah. And I'd say like, the principal thing is like the principal concern for a lot of people is volatility. I've found that oil and gas retirees have iron stomachs when it comes to volatility, because they've seen oil go negative. They've seen booms, they've seen busts, they've seen embargoes, right? Like I don't know. So like a lot of them, that's not the principal thing they're concerned about. But I do just like that framework of, hey, what is the time horizon? What is the net present value of my expenses? And then, okay, what's the time horizon of the beneficiaries of all that, assuming there's a decent probability that my assets are going to outlive me. So, Scott, I guess one more question for you. Like, I know that at various times you've done this yourself, you've worked with an advisor. Any advice or thoughts on, when does it make sense to DIY? When does it make sense to hire somebody? Any thoughts you kind of have more generally on helping somebody think through that decision? Because like I find that a lot of our client base is like skews engineer. So there's like a lot of technical competence and interest. And so like, I'm an advisor. So of course my biased answer would be, yeah, it always makes sense. But I realize like there's a subset of the universe, that has a spreadsheet that's probably more as robust as the financial planning software I would put it into. Right. And so, there's definitely a lot of people we know in this space that are technically competent enough to do all this themselves. And you are obviously someone in that camp. So I'm curious how you've thought about that at various, in general, or maybe if that's changed at various points in your career.
Yeah, there's probably a couple subsets of people and that make up a large portion of the population that could do with some financial help, some formal financial advisory. And I DIY'd for a long time, as we've talked about. But as I got closer to retirement and my situation became more complex, I started working with you all to help me think about the things that I didn't know, to have a second set of eyes on the ideas that I had, and to put some structure to what I was doing. I think there's a couple bigger groups. There's what I would call the outsourcers. That and this is the majority of people. They just don't want to spend the time. They don't have the knowledge, and that doesn't mean that they can't get the knowledge, but they don't want to spend the time to get the knowledge, and they don't, even if they had it, they don't want to spend the time working on it. I think that's the majority of people that are out there, and also people that would benefit from a financial advisor, especially when their assets get to a level that is beyond just a very basic plan. And then there's kind of high earners and business owners where their situation is complex. They want to apply their time to other things. And then I mentioned I was a triathlete, and I have a lot of triathlete friends that have coaches, and they have coaches to design a plan for them, and then to give them the discipline to follow it. Because people are people, and a lot of people need help in just the discipline to follow the plan. You can have the best plan in the world. If you don't follow it, it doesn't mean anything. And financial advisors, I think, provide that discipline for a lot of folks to keep them out of, doing the wrong thing at the wrong time.
Yeah, I love that. And you made me think of bringing triathlete into it. Made me think of like hiring a cycling coach. It like increases your mileage, right? So if I ride my bike 5 hours a week just willy nilly with no organization and structure, I can have drastically different gains in fitness if I have a coach helping me optimize the different zones and the types of
Exactly.
recoveries that are doing that, right? So I'm exerting the same amount of an effort or same amount of time to it, but my results are multiples higher because I understand all of the zones and what helps me optimize for recovery and sprints and all that stuff. And again, the same amount of time, just getting more mileage. So as you were talking about that made me think of that analogy. I think it's so good.
Yeah, that's exactly what I meant. Yep.
Awesome. And Scott, so as we wrap up, I just want to say thank you. I appreciate it. I'm really grateful we had this conversation because all of this is so fresh in your mind, right? Like this is like it's a fairly new thing for you. So I appreciate it. It's vulnerable to come on and kind of share. And I appreciate how open you've been with our audience. Is there anything else, you'd like to share with our audience that we didn't get to cover, whether, and it can be a segment of our audience, whether new people starting a career, people that are, would be in the retire in five yammer if they worked at ExxonMobil, but that, they're kind of looking down the crosshairs of retirement, any advice you would have or anything you want to share?
Yeah, I don't know if I have anything monumental to to add to what we talked about. Hopefully it was interesting to your listeners. I would say that, the financial topic is difficult for a lot of people to talk about openly. I've learned a ton talking to friends in the same situation as me, sharing a little bit more than I was probably comfortable with. And we learned things from each other. A, that we're going through kind of the same sorts of things, and B, that they may have an answer to things that I didn't know. And so, expanding your net a little bit, always with a bit of caution as to making sure that, not everything that you hear is right, as we talked about, but expanding your network to share and learn from other people, I think is a really great way to go. And try not to be too insular when it comes to the financial topic, which is something that a lot of people are trained not to talk too much about.
Yeah. Money is definitely taboo, but I think magical things happen when like-minded people or people just with different minds, but in a similar situation, get together and they're just a little more transparent about, the math, but also, all the stuff that goes with that, the relationships, the things you're optimizing for, your hopes, your dreams, your fears. So, well, I appreciate you coming on and taking time to share this with our audience. That's all we got for today. We'd love to hear from our listeners. Any thoughts or questions or ideas for future podcasts? We're always just improvising and love having great guests. So if you want to be on the podcast, we'd love to hear your story. Podcast@brownleewealthmanagement.com. Thanks. We'll see you next time.